Every financial system sees the problem early. They just choose not to face it. Welcome to Wheelixon, where history isn't just remembered, it's used to understand how money, power, and systems quietly break. Every financial system promises the same thing: transparency, responsibility, correction. But applied financial history shows a pattern so consistent that it almost feels deliberate. When reality becomes uncomfortable, systems don't confront it, they delay it. Not because leaders are stupid, not because economists don't understand the numbers, but because confronting reality threatens stability, and stability is what systems exist to protect. This behavior isn't new. It didn't begin with modern central banks, financial media, or global debt. It began the moment power realized that truth has consequences. The earliest monetary systems were brutally honest. If a state ran out of gold or silver, it ran out of money. If it overspent, it failed. Truth enforced discipline, but discipline limits power. As states grew larger and promises multiplied, armies, pensions, infrastructure, welfare, honesty became dangerous, because honesty forced immediate pain. So systems learned something crucial. Reality doesn't have to be denied. It just has to be postponed. The Roman Empire understood this perfectly. When Rome spent more than it could tax or conquer, it didn't announce bankruptcy. It debased its currency. Silver coins contained less silver. Gold coins became thinner. On paper, nothing changed. People still accepted money. Wages were still paid. The system looked stable, but purchasing power quietly declined. Rome didn't collapse suddenly. It eroded. Reality was delayed, and the delay preserved power for generations. That was the first version of the playbook, and every financial system since has refined it. In medieval Europe, monarchs faced constant war expenses and weak tax systems. Default meant rebellion. Rebellion meant death. So rulers borrowed, diluted, delayed. Failure was never admitted. It was managed. Fast forward to the modern era, and the tools change, but the logic remains identical. Today, systems don't debase coins, they manage narratives. Inflation isn't failure, it's temporary pressure. Debt isn't unsustainable, it's manageable. Banking stress isn't systemic, it's contained. These words aren't lies in the legal sense, they are stabilizers, they prevent reaction. Applied financial history shows that the most dangerous phase is not denial, it's selective truth. When systems release just enough reality to appear transparent, but not enough to force correction. Consider inflation. Historically, inflation was a warning sign. It meant promises exceeded resources. But modern systems don't treat inflation as a warning. They redefine it. Certain costs are excluded. Averages smooth spikes. Methodologies evolve. The goal isn't deception. The goal is stability. Because a public that fully understands purchasing power, erosion demands change. And change threatens control. The same pattern appears with debt. Governments rarely default openly anymore. They extend maturities. They restructure. They inflate obligations away. Debt doesn't disappear. It dissolves slowly. Reality is not confronted. It is stretched. This behavior peaks during what history calls the management phase. This is when systems stop trying to fix problems and focus entirely on preventing collapse. Interest rates become tools of calm, not signals. Liquidity becomes permanent, not temporary. Emergency measures become standard policy. What begins as exception becomes normal. At this stage, systems often appear strongest. Markets function. Volatility is low. Confidence seems intact. This is the illusion. History shows that maximum calm often precedes maximum fragility. And why does delay work for so long? Because people tolerate gradual loss better than sudden shock. Living standards erode quietly. Opportunities narrow slowly. Costs rise incrementally. There is no single moment to resist. This isn't conspiracy. It's human psychology. Applied financial history teaches that collapse is rarely a moment. It's a process built from thousands of decisions that all make sense individually. Let's wait. Let's reassess. Let's avoid panic. Together, those decisions create fragility. Japan provides a modern example. After its asset bubble burst in the early 1990s, Japan faced massive insolvency. Banks were effectively bankrupt. Debt exploded, growth collapsed. But Japan didn't allow collapse. Losses were absorbed slowly. Banks were supported quietly. Debt expanded endlessly. The result was not crisis. It was stagnation. Reality was delayed indefinitely. The system survived. Momentum didn't. Western economies followed similar paths after 2008. Collapse was avoided through unprecedented intervention. Banks were rescued. Markets were stabilized. Interest rates were suppressed. The system didn't reset. It adapted. Failure was transformed into stability. This is why economic systems feel functional but strained today. Growth exists, but feels hollow. Employment exists, but feels insecure. Stability exists but feels fragile. These are not contradictions. They are outcomes of delay. At some point, however, delay reaches its limit, not because leaders choose honesty, but because constraints become unavoidable. Inflation accelerates. Debt confidence weakens. Capital shifts direction. When that happens, reality asserts itself quickly, and people say, no one could have seen this coming. But applied financial history disagrees. The signals were visible, they were just postponed. Understanding this pattern changes perspective. Instead of asking, why did the system fail? You ask, how long was reality being delayed? That question reveals far more than any forecast. This doesn't mean delay is always wrong. Immediate collapse can be catastrophic. Delay can buy time. But delay without correction is not stability. It's borrowed time, and borrowed time always carries interest. Every system that delays reality eventually pays for it, in lower growth, in reduced opportunity, in weakened trust. When trust finally breaks, collapse feels sudden, even though it was decades in the making. Applied financial history isn't pessimism, it's clarity. It shows that systems don't collapse because people panic. They collapse when reality no longer fits the story being told. Panic comes later. If you understand this, you stop chasing events, you stop reacting to headlines, you start watching behavior. Because behavior always reveals the truth before narratives do. If you want to understand money and power beyond headlines, subscribe to Wheelixon.